Alright everyone, in this video I'm going to show you how to take a seemingly complex or non-directional chart and turn it into something that actually makes sense. I'm talking about going from a chart that has you scratching your head to one that's super easy to read and understand. So let's start with this NQ price action here, a 5-minute price action that is. Now my trading routine, and by the way here, I will be covering another trade a bit later in the video. The first trade we are about to sort of discuss turned out fine, but the second one, it ended up being one of those half-ass trades. I should say that didn't quite pan out as expected. So as I was saying, my trading routine always starts by identifying a trading range first, and then obviously key areas of support and resistance, which means basically pinpointing where the market's swings are. In this particular trade example, the market is clearly trading within a well-defined range here with resistance up at this level where my stop loss is placed, and support down here where the market has bounced off multiple times. In my view, the reason trading ranges are effective or work so well is because they let you gauge supply and demand. In other words, when the market starts testing key swing points like these ones over here, it gives us a clearer, I should say, picture of how strong or weak the supply and demand forces really are. As you can see, the market went through a bit of a test of this flip zone here. It first broke below the 625 support level, but then quickly bounced back above it. This is what you would call a mini bear trap, meaning this quick drop below support here looks like this sudden shift in price is about to continue, but instead this very move actually signals the end of the decline, catching those late short sellers off guard. The idea here is that you can kind of sense how strong the supply is by how deep this dip actually goes. And in this case, we can see that it's pretty shallow. That said, though, even with this steady upward move that follows, I wouldn't jump into a long position just yet. I would rather wait for clear signs that the markup phase is about to kick off. And these equal lows right here, especially this secondary test that's followed by this strong demand bar, are what I would be focusing on as a solid entry point for a long trade. Obviously, I missed out on this opportunity, but this is how I would have played this entry. So after the markup phase here, we can see the early signs of a distribution phase kicking in as the supply starts to show up in these red bars, and then there is this clear pattern of wicks getting shorter with each candle, as you can see, all basically here struggling to break past the 687 level. This is, relatively speaking, a strong indication that the market is leaning more toward its short side, a probability further, I should say, reinforced by this failed attempt to break through resistance. Structurally, this move didn't even produce as you can say, a marginal change, and instead led to a sharp reversal. The fact that the price had no impact up here suggests that the market has entered a markdown phase following the distribution phase. That's why I put my short on at the 72 level, betting that the market was shifting south. From there, as you can see, I just let things play out as the price kept getting drawn towards these lows. Now, predicting where the price will go next is always a challenge, but in this case, the exhaustion of this upward move into the distribution phase gave some pretty clear signals. It helped me first define a range, and then once I recognized the same range as a markup phase, the following distribution and markdown phases became pretty predictable. So in my view, this whole accumulation, markup, distribution and markdown cycle turned what seemed like a somewhat noisy and non-directional chart into something much simpler and easier to interpret. See guys, in my view, once you have got a basic understanding of Wyckoff's cause and effect law and price action patterns, reading the charts gets a whole lot easier. Alright, let's now move on to another trade. So this one didn't quite go as planned. Now my approach on this entry was simple and mainly based on the idea that the price was showing a clear shift in bearish momentum up here, essentially cancelling out the previous bullish movement via this stop hunt zone and the subsequent formation of a head and shoulders bearish pattern. And as you can see, again, after this 100-point run, we started moving sideways. Then after printing a higher high up here, the price dropped, retraced to then bridge the support of this sideways channel. My thought process here was, since the market kept failing to push higher, as seen in these instances, once we broke below this third ascending mini trend line driver, which in this case it would further signal a depletion of bullish sentiment. And on top of that, I thought if we convincingly break below the 95 support level here, the price would really tank. However, it didn't quite play out that way. To be fair, my first target did get hit, as you can actually see from the action, which was a nice win, and I'm not complaining about it. But when it came to my second contract, things didn't go as smoothly. The market didn't continue in my favor, and I ended up getting stopped out before I could secure that second profit. This was one of those moments where the trade initially looked promising, as a market seemed in a final attempt to puke lower, but it just didn't turn out that way. I guess I was looking here for this perhaps somewhat extreme low down at this level, to align with these order block, but the momentum just didn't hold. I have to say here that the market did actually give me plenty of clues with this sequential extension pullback type pattern, but I just wasn't able to fully pick up on them. So as much as this trade showed promise at the start, it's a reminder that not every setup will go according to plan. The market obviously can be unpredictable, and even when everything aligns perfectly, it's still important to manage risk and stay adaptable. I guess, guys, the key takeaway here is to recognize when a trade isn't working out and not to get too attached to the outcome. You have to remember that you learn just as much, if not more, from the trades that don't hit all their targets as you do from the ones that do. So keep refining your approach, stay disciplined, and be ready for the next opportunity. And by the way, guys, if you want to supercharge your price action game, don't miss this next video. Alright gang, thanks for watching, and as always, hope to catch you all in the next one.